Hey, good morning and happy trading to all that are joining us. Let's see what we've got this morning. Steve, can you hear me?
Roger that.
Greg.
Yes, I'm here.
All right, and let's see. Who's going to tell me if they can hear us okay today? Can we get a quick volume check? Everybody got their coffee, Spark, whatever you're drinking this early?
Yeah.
I want to make sure the comments are working okay. I had a few emails the other day about the comment section, and just to remind everybody, you have to be subscribed to the YouTube channel and logged into that Google account. Thank you, Kevin. In order to be able to comment. So a lot of times, like you know, if you have multiple Gmail accounts, you'll be in one and think you're in another. If you're like me, it happens all the time. Just if you're having any issues, message me at support@thetraders plan, but make sure that you're subscribed to the channel before. I mean, that's probably what the feedback I'm going to give you. Yeah, just taking care of business. All right, boys, what do you got? How's the market looking?
All right. So here's what's going on with the market right now. Can you see my screen of the Dow Jones Industrial Average?
I can.
Good. Okay, that's what I want you to look at. This is where we're at. We're just at a relatively small pullback right now from the highs. So in and of itself, again, it doesn't mean a whole lot that the market's having a pullback. Okay. It's pretty typical for the market, like we talked about last week, to have a pullback during the year, especially in the summer and early fall time period. It's very typical for the market to bottom out in September or early October and then rally to new highs at the end of the year. So this is pretty typical of what we're going through right now as far as the pullback. The real test where we're at is going to be if we rally to new highs by the end of the year. That should be a big indication of where we're at and where the market is going. Now, a few things that we need to talk about that could have huge impact on the market. Number one is Evergrande out of China. This is a great big real estate company in China. And I did some research on them, and they have $300 billion in debt. That's a lot of debt. And the fact that they couldn't make their just $35 million bond payment last week is a big deal because it's such a small payment for what's supposed to be such a big company. What that tells me is that China is in a bubble and they have a lot of debt. And if this blows up, it could affect our markets as well. And that's what you saw our stock market react to last week. Okay, so this
was last Thursday that they missed this payment?
I think it was actually Friday.
Okay.
And so if you can see my screen where on Reuters where it says the Chinese government is asking state-backed or government firms to pick up the assets, that's telling you that's a bailout right there. Okay, so we need to keep a close eye on that to see how that plays out. Okay, that's one. The other thing that's making the stock market a little bit jittery is what's going on in the bond market. When yields go up, it means bond prices are going down. Okay, so bond prices are a leading indicator for the stock market. And the fact that they're a little bit weak right now, in and of itself, doesn't mean a lot. But if that continues, that'll make the market further nervous. But so far we're okay. Okay, so that's what's going on.
Steve, is there anything you want to add to that?
No, I completely agree with that assessment. Bonds usually lead. They usually correct first, and then they usually bottom first. But, one thing I was saying to my subscribers this morning, just kind of drop a little wisdom. Embrace, if we get a correction or something a little bit deeper, that's completely okay. It's completely normal. It's completely healthy. Where a lot of money is made on the snapback, right? Strong trends come out of ugly markets. So now that the market is correcting and we don't know if it's going to last a day, a week, however long, but you should be paying attention to the stocks that are bucking the trend, right? The stocks that are really hanging in there, trimming your watch list. So this is a time for preparation and, for when the rally resumes. And this is also a time to really look back at your last 10 to 20 trades, see what mistakes you made, see if there's anything you can tighten up. Now is a great time to really do that homework when the market's coming under pressure. There's not a whole lot of aggressive buying.
Absolutely. When the market is weak, like it is the last few weeks, that's an excellent time to see those stocks that are showing relative strength, because those are the stocks that are going to zoom up as the market climbs up again, assuming that it does. Stocks that won't sell off when the market is weak are the first to go up when the market gets strong again. So those are stocks worth watching for. Now, as we look at the Dow Jones Industrial Average here, this is what's going on. I hope you can see that large enough so you can actually see it. Let me blow it up a little bit. Now, I've got a couple things for you to look at. First off, I noticed that the purple line in the middle there, that's the 50-day moving average, one of the things that I look at carefully. And what I see here is, I see that the market went below the 50 and then bounced off it a few days ago. Now, that's not a big deal by itself for the short term, but if that continues, that's a sign of weakness. Normally, during the weak period of the summer and fall months, the market will pull back between 5 and 15%. It's actually a sign of strength that the market is only down about 4 or 5%. So it's just a tiny pullback, really, based on historical standards. Okay. But right now, because the market bounced off the 50, that's the first sign of trouble, basically. We're still above the 200-day moving average, which is this green line down below. That's the big one that the hedge fund and the big money look at. Okay, the hedge fund managers and all the professionals, smart money, they're looking at the 200-day. It's a big sign of weakness if it stays below the 200-day moving average. It's no big deal if it goes down and hits it or even drops below it briefly. But if it goes down and stays down below it, that's a huge warning sign. Okay, just kind of giving you a backdrop on what's going on in the market. Okay, now I'd like to show you a trade that I did. This is VEEV. Now, we don't have $1 billion that we have to manage. We have relatively small amounts of money compared to the professional money. So we can get in and out of stocks as quickly as we want to, basically. As long as we're not trading penny stocks, we can do that pretty easily. So I want to show you what I did. VEEV gapped down on this day on September 2nd. And I was watching it, and it looked like it was going to fill the gap. So I bought it the next day on September 3rd. And I saw that the very next day, this was Monday there, that things weren't working out and it was headed lower. So I exited the position there and watched it. And as it started to go lower, I shorted it right there at 308 higher during that day. And it's done really well. So I'm still short this stock at 308. And I'm in the money about $21 per share. And I'm still holding on to it. Now, there's lots of ways that you can trade this that I've talked about before, depending on if you want to do a straight stock trade or you want to do options. You can short it. You can sell a call on this day or this day. You could have sold it around 310, 312, something like that. Or you could even buy a put if you have confidence that it's going to keep going down lower. Now, in this particular case, I just shorted it. But doing credit spreads, let's say that we were bullish right there with using a credit spread, and we wrote a put down about, let's say, around maybe 315, 312, somewhere down below. If that happens, we would have taken a loss on this trade, and if we had flipped it, then we could have made money on the other side, just like I flipped it on the stock. Okay, what I like to do as much as possible is see where the stock is going to take me, where the stock is going, and then jump on a trend. Okay, so that's going to help you to know which way the market is going and be right more often in your trades.
So what would you do with it now, or is this not something you put anything new on?
I wouldn't enter it right now. It's too far. It could bounce up at any time. I don't know. It might keep going straight down, but I like to catch a trend early on.
Sure. So not a credit spread position that you would tell people to enter now.
Not right now, no.
There is a question about last week's credit spread for IBM. Kevin wants to know if you're still in it.
Yes, I am. Let's look at that.
Okay.
Okay. For IBM, we sold a 139 call, and it's up to 140. You have to remember on these that most of the time, just because it goes up a little bit above the price where you sold the call, that doesn't mean it's going to be exercised. It's wait until the trade expires, till the option expires. So do I want the stock to be up here? No, of course not. If I wrote a 139 call, I don't want it to go above it. But it's okay because I'm still thinking it's going to come back down. We'll see. Remember, I have the odds of about 70% in my favor. And if I read the charts correctly, it goes up even higher. So I'm going to let it ride. Let me show you something else. One reason why I love Yahoo charts. I'm going to go to a 5-day on this. Okay, look at what happened with IBM today. Yesterday, it closed at 139.19. It had bounced up during the day and closed down here. Well, it's gapped up to about 140, where it remains in price right now, about 140. One of the tricks that traders use, professional traders, the floor traders, is that they'll gap stocks up that they know that they want to sell all day. And sometimes they do that to give themselves higher prices, and they'll sell it off all day. I don't know if that's going to happen here with IBM, but you can see that they've gapped it up, and it's not going up much from where they gapped it. So they might be doing that. Like here, they did this on the 28th, which was a couple days ago. They gapped it up and sold it off all day. Okay, now it still rallied the next day, but they might be doing it again. So I'm going to watch this carefully. It looks like it might be due for to drop from here. But anyway, I'm going to stay in the trade on that. Okay. I'm going to let the odds work in my favor. It looks like right now it might be bouncing off the 50, going above it a little bit and coming back down. I'm not sure yet. We'll see.
Another continued question with IBM. Would you sell another one at this price?
I'd like to watch it a little bit more before I do it again, but yeah, I might do that, because look at history. The recent history is the best indication of the future, right? And so back here, we've got IBM bouncing off the 50-day as resistance here and here and here, and it was below it, bounced it off it there too. So like 3 or 4 times it's bounced off the 50 after going to it or slightly above it. Looks to me like it's doing that now. Could I be wrong? Sure. It might go up from here. I don't know. But that's what I'm gambling on. That's what I'm betting on. You'll also notice that the purple line, the 50-day moving average, it's going slightly downward. That's showing you that the whole stock is in a slight downtrend. And you can just look at the charts, the candles on this, and see that that's true. It's slightly down. slightly lower highs and slightly lower lows.
I've got a question. I think it was towards V, though. Luther is asking that was towards V, right, Luther? When you're asking when he shorted it, did he hedge with a call? Did you buy a call, Greg? No. No. Gotcha. Well, plain and simple. He did not.
Okay. So here's the thing. This class is about credit spreads, which means making income from selling calls and puts.
That's right.
And then protecting ourselves with buying a higher call or selling a lower put in case things go wrong, so that we limit our risk. The market seems to be getting a little bit more volatile right now. And so when that happens, I tend to want to be on the other side of that trade and buy calls and puts. Okay. I don't know how much I want to get into that right now because we want to stay focused on credit spreads for income. But when you get volatile markets, you can make good money by buying calls and puts, but you got to be really conservative and careful about it. You don't bet the farm on it, right? Because the whole thing could drop and go to zero when you buy a call or a put. If it expires, worthless.
Greg, I think anybody on here would be totally fine with, and I am. Do you have something that you want to look at? Do you have an example of something volatile that, just for fun?
Okay, well, let's see here.
But you're right. The majority of this class is about credit spreads, but we'll be realistic. This is also about options. People want to, learn how to trade options in a conservative way. How would you do it?
So one way that I could have done it, I didn't do it, but I could have done it this way, is right about here, I realized I was wrong. And I took a loss on my previous long trade, thinking that the stock was going to go up. If I had an idea that the stock was really going to follow through, and I did, I could have bought a put on this. Now, this is the way I like to do it. I like to buy puts that are at or in the money. Why? Because if you buy an out of the money put, let's say I bought a put way down here around 300 when the stock's at 308. Well, the stock has to travel a long distance before you make any money. And then you don't make one for one once it hits that price. Okay. That gets into the Greeks, which is complicated. Don't want to dive into that right now. But basically, when the stock price hits your strike price, let's say at 300, and then goes down to 299, that's a $1 lower than the strike price. That doesn't mean you make $1 in the option. It's less than that. It varies. It might be 50% or 60%. So the bottom line is, the takeaway from this is, without trying to get too complicated here, is that you want to buy in the money calls and puts so that you can get closer to one for one when the stock moves in the correct direction. You make more money sooner. What a lot of option traders do, which is a losing strategy really, is buying, like, let's say the stock was back here at 308. They'll buy a whole bunch of 300 puts and the stock won't go down there and they'll lose all their money. It's too far out of the money. It's high risk. It's high reward if the stock goes far below that, but that's not really the best way to do it. It's a low odds of success when you do that. And a lot of option traders are really doing that. They're swinging for the grand slam.
Right.
I don't want to do that. I would much rather have consistent, steady winners.
So you're saying, and we get a lot of questions about buying calls and puts on here outside of the credit spread realm. You're saying your conservative approach is buying in the money or at the money, calls or puts, based off your feel of where that stock is going, as opposed to the very common, buying 10, 20, 30% out of the money, hoping for that grand slam, chasing an earnings call or something like that. You're wanting, okay.
Exactly. Don't do that. Don't do that.
He's right. He is right. And I know there's the appeal to it. But, for some of you guys that are just getting into options, that is a really strong appeal, especially when you're looking at, marketers or other traders who are telling you there's this big money in doing that. Don't do it. Just stay close, be conservative. It's already a risky play as it is. Options is a risky play. So don't forget that. There's no sense in, it's like the roulette wheel. Just stay on the outside.
Okay, so when the stock was at 308, I would want to buy a put. The time decay is faster in the last 4 to 6 weeks. So I want to buy at least 3 months out or even longer. Now, the thing is, you have to pay more money to hold the trade when you do that because the option is going to cost more, but you'll get more back when you exit the trade.
It's your buying time.
If you're buying, so if you're buying a put at 308, then and it's in the money and it's 3, 4, 5, 6 months out, it's going to cost you more money than a shorter time period, but it's worth it because you're going to get more bounce for your buck when the stock moves in the desired direction. You're going to make money faster and you're going to retain more of the time value by doing it 4 to 6 months out as opposed to 1 month. Think of this, what could have happened. You buy a 308 put, the stock is at 308, and you only have a 1 month duration on it. What if this had happened? Instead of the stock goes down, it bounces up and down for 2 months and then goes in the direction that you expected it to go. Well, you were right, but not in time. And you lost all your money on the trade because of it.
Now, here timing is important. So that's a little lesson outside of the realm of the credit spreads. Now let's do we have anything that we're really
Can I add a lesson in real quick?
Add a lesson, Steve.
And this is just, I've just been chomping at the bit to say this. This has nothing to do with options, but that Viva trade right there, I think there can be a lesson learned for the fact that you made a trade and you're willing to change your mind at the drop of a hat, right? Like it didn't go in your direction. When you buy something and it doesn't do what you thought it was going to do, the willingness to immediately get out or the willingness to change your mind and go the other way, that's incredibly important because there's something psychological with all of us that says, hey, we want to be proven right. We'll give it a little bit more time. Maybe it'll bounce back. And then the next thing you know, you got a much bigger loss than intended. So I think the willingness to just pivot, and not kind of stick your flag in the sand and be like, I'm bullish and this is just the way it is. I think that's incredibly important in the mind of a successful trader.
Stop loss all around, no matter what way you're trading.
Absolutely. You should have no emotional attachment to a trade.
Easier said than done, right?
Yeah, you should be able to turn on a dime. Why did I exit right there? Because if the stock was going to continue going up and it was just a little pullback, it would have stayed around the let's see, what price is that? Around the 315 level. It would have pulled back a few dollars a share and then gone back up, gone sideways and then gone up, something like that. When you see a great big down day like this, it shouldn't be going down there. And so I exited on this day, and on the following day, I watched it carefully and saw there was more selling pressure. So I entered my short position on that day. Okay. And do I know for sure it's going to keep going down? No, I had no idea I was going to do this well on the trade, but I'm still in it and it still looks great. Now it bounced up today, but I'm still not convinced it's starting a new uptrend or a reversal. The chart is not indicating that yet. It's not even above the high of the previous day yet. Let's go back to the 5-day. And in fact, it looks like they bounced it up and they're gonna, well, they're not selling it off, but it's pulled back a little bit from the high. Anyway, I'm not concerned about this at all yet. I'm gonna watch it, keep watching it, and it may have plenty of more room to go down. I'm not sure yet, but I could certainly ring the cash register right now and be just fine with that. Over, let's see, over $20 a share in the money. That's not bad. Okay. Any questions about that? Any further comments about Vive?
This was a big winner for us last year.
Oh yeah.
And to add to, hey, don't fall in love, or don't have, don't just stick with an idea, right? This was a big winner for us last year. Viva, now it's looking pretty weak, or it looked weak last year, but don't fall in love with anything, any idea, any single trade. There should be no emotional attachment unless you literally started the company.
I like that. I like that. Now, looking at the big picture, this is the 6-month chart. This looks just like a normal pullback. It's, if you look at it this way, it's bouncing, or not bouncing yet, but it's at a major support level right there. We'll see if it goes through it or not. But basically, looking at the big picture, this is just a normal pullback. This might start a new uptrend at some point. So I can't fall in love with my short position either. If it looks like it's reversing, I'll exit and ring the cash register and be on to the next trade.
So Luther has a good question about the whole process of creating income from options trades. I don't know that it can have a direct answer, but let's give it a shot. So how many positions do you have at any one time? And what he's getting at is, to create income, you either have to have a lot of positions or larger positions to make decent weekly income, which obviously is relative to what we, agree is decent weekly income. But you get the point of the question, right?
Yeah, absolutely.
So, volume on how many, or, more contracts on one? Where do you sit, Greg?
Okay, so that's a question of risk.
Sure.
On any trade that you do with options, it's in fact, any trade, it's risk versus reward. You always limit yourself to the number of contracts or the number of shares that you trade based on the risk. Okay, so for example, let's just say that back here at 308 on this day, if let's say I wrote a call option above it at 310, and I put another call for protection at 315 at higher. If my max loss was, say, $300 for one credit spread, are you okay with that loss if it goes south? Well, okay. If you do two contracts and the max loss would be $300 per credit spread, now you have $600 potential max loss for two credit spreads. Are you okay with that? Most of the time, the answer would probably be no for beginning traders, unless you're Bill Gates or something, have a lot of money or whatever. But for most beginning traders, you should stick to one contract per spread and do multiple spread trades.
How many per week would you say? Or how many would you say that you have open at one time? And I realize, you kind of got to find your number for what you think weekly income is. So let's just say, hypothetically, Luther wants to make $500 a week. If, you know what I mean? Like, he's got to work backwards from there, knowing if I'm, getting 75%, what's the risk that I can put out? What's the amount of income that I need to, bring in from each trade? How many trades does it take to get that formula working?
Okay. I would think that it would be about, not per week, but about 5 to 8 credit spreads at once. I would much rather have 5 to 8 trades at once and monitor it closely and know that I have the odds in my favor, rather than do, say, 2 credit spreads, doing a lot of contracts per credit spread, because if it happens to be one of the losers, you're going to take a big hit.
Right. And what I promise, Luther, that Greg is not saying right now is go find 8 credit spreads to jump on tomorrow, because that's going to cost, build that up. It's just like with any system that you're getting into where the trades come in and go out, like build up that portfolio of credit spreads.
Absolutely.
To where you are closing them out and rolling them in, right?
Mm-hmm. And that actually leads to the paid content that we're going to be getting into. I'm going to be offering my number one indicator to enter a trade and how to set up options trades around it for both credit spreads as well as buying and selling, buying calls and puts to enter a trade.
And you're going to be doing a private workshop with that too.
That's a private paid workshop for those who want to really get into it and get into advanced material and have a very advanced, close look at things, at what I do.
Which
I'm going to show you where I find those trades online, which is great.
Right. So that webinar is you're starting that next week, October 7th, or at least the presentation for that. Is that right?
Yeah. We're going to do the presentation for that next week. I believe we said the 7th, wasn't it? I think it was the 7th. We're going to talk about that, and I will go over more about what I'll be teaching in the class. But that's essentially it, what I just described. We'll get into more details on that coming up.
Yeah. What if you're going to sell? Sorry, a couple questions came in at once.
Okay.
You're going to sell a 310, 315 call spread. How much time would you sell? 4 weeks? Is that where you're staying? As far as like the credit spreads that you're giving out, 4 weeks minimum, 4 to 6, depending on what's available.
Again, the time decay goes faster over the last month or so. So I really like to keep it around a month. Sometimes as short as 2 weeks. I really like to not go much further than 1 month, personally. A lot can happen these days pretty fast in the market. So I want to make my money and get out and do it again, basically. Is there another question?
Let's see. Kevin, what is the cost for that session as far as the advanced options? I don't know. We honestly haven't bullet pointed everything that's in it. We're building it right now. We'll know by early next week. But we are doing still for some these free credit spreads, still sending those alerts. This is definitely an advanced part of it. But don't think that it's going to shut the door on everybody who can come to this and who wants some free content. We still got that open. But I'll let you know early next week. It won't be, we'll have some kind of charter class discount for sure.
Absolutely. If you're serious about options, this is something you don't want to miss. This is going to be really good. I'm going to be teaching more of the things I look at in technical analysis, which helps you become a profitable trader. And that'll be useful whether you're trading stocks or options or anything else.
Absolutely. So what is our credit spread for this week? Are we getting into something else, or did you launch that? I missed yesterday, so if you guys sent an alert yesterday.
Yeah, let me show you what I put out. Okay, this is 3M.
3M
is a huge company. I love great big companies like this because they're like elephants. It's like the Titanic being able to turn quickly compared to a speedboat. This thing is huge. And so when it shows a big down candle like that on heavy volume, nobody's going to want to buy back into that real quickly. They're showing lots of downward pressure on this. Okay, so for 3M, we've got we sold a call at 185 on this. And we've got a short duration on this until October 15th. This went out yesterday. So where's 185? It's right there. I just don't think 3M has got the strength to go up above 185. It may bounce up to that price, but I just don't think it's going to go above that. So we're selling a 185 call. And for protection, we're buying a 190 call. This is only about a little over 2 weeks, and the credit on this is about $90. I think it was $94 we got on the trade yesterday. Okay.
That's correct. It was 94.
Okay. And then it's just, I mean, these days commissions are so cheap. It was only $1 or $2 to do the trade, to enter the position, $1.50 or something with fees. So that's really low. Okay. So there's excellent odds that this is going to work out just fine. Remember, your odds of success, if you do it right, at least my odds of success are between 70 and 80% when I do these trades. Let me show you one that didn't work out. In the interest of full disclosure, I guess. Hold on a second.
So that's live now. IBM's live. Is that it as far as current credit spreads?
Yeah, we'll keep going. I'll show you.
Okay.
Okay, so here's American Express. Let's see here. Let me pull it up. For American Express, we did a 165 call expiring in 2 weeks from now. Well, it jumped well above that because an analyst put some valuation around 190, I think it was, or something. So it popped way up. I hate it when news comes out of nowhere and messes up my trade. Up until that day, the trade was looking great on the short side, but it bounced up. We got exercised on this trade, so we took a full loss, which means that, let's see, it was about a $400 loss on this one because it shot up like this. Well, that's going to happen once in a while. You gotta expect that. If you're not comfortable with that potential loss, that it's too big of a trade. When you enter these trades, you know what the risk and the potential reward is going to be. If you're not comfortable with the risk, you don't do the trade. Okay, that's how that's supposed to work. So this is one of the few losers I've had.
So how much of that, of the 400, was paying out the exercise call versus the other call that you had sold or bought?
Okay, so the risk on the trade when you do this trade is $500 because that's the difference on the spread, the 165 to the 170s, minus the credit that you got. Okay, hold on. Okay, the credit we got on this was about 130.
Mm-hmm.
So it was actually 370 was the total loss on this.
Okay.
Okay. Which is the 130 is the income I got for writing the spread minus the losses. So it turned out to be about 370. It's going to happen once in a while. The broker holds on to that money in your account to cover a potential loss, and they took it when it was exercised. That's
so. But you had a higher call. Is that figured into the math that you're saying? I'm just missing it.
Yes.
Okay.
Yeah.
So that offsets a lot of what was exercised.
Which is very cool because if I sold the 165 call and I got a credit of 130, that means that break even goes from 165 up to $1.30 higher than that, or 166.30. So it's even higher before you start to lose money, which is very cool. But again, this only happens, once in a while. So,
but it does happen. Be prepared.
Yeah, it's going to happen once in a while for sure. I don't know anything that wins all the time in the stock market. I wish I did. Okay, let's look at some other trades. Let's see, IBM. We got IBM. Now, for IBM, we sold a 139 call. It's bounced above it a little bit. I'm still anticipating the downtrend to resume and for it to come back down. So on the short term, I'm not too concerned about this being up here. I'm expecting the downtrend to resume. Okay. So there's that one. Let me look at another one that we did. This is the other side of the trade. This is Snap. Snap gapped up on July 23rd, essentially been going sideways since then. So what was the day I entered this on October 8th? Hold on a second. Nope. September 22nd to October 8th. Okay. So let's go to that September 22nd. Right there. Sometime during the day on that candle, we sold a 171 put. When you sell a put, you're bullish. You don't think it's going to go below 171. Excuse me, 71. Okay. So even though it pulled back to a support level, it's still above 71. We're still completely in the money on this. We're only going to lose if it goes below 71. It looks like it's starting to reverse, might be heading back up, but it's held the support level that I wanted it to hold. So we're good on this so far. Is everybody with me?
Yep. Sorry, my mic was muted. I forgot.
Okay.
So we're good on Snap.
Yeah, we're good on Snap.
Still sitting in IBM.
Yep, still watching that. And also Disney. Let's look at Disney. We're fine on Disney.
What's the expirations on Disney? Forgot.
The Disney actually expires tomorrow.
Okay.
So for Disney, let's see here. I'm looking at my spreadsheet right now. Okay, so we sold the 185 calls. Okay, hold on. No, September 3rd to October 1st. So September 3rd was that day. On that day, we sold the 185 calls. And it went up there slightly above and then came back down, which is okay. Now it's way down here, and we're going to make all the cash on that trade, maximum profit.
Which is?
Which was just shy of $100. $1 per credit spread.
Perfect.
So Disney acted exactly like I thought it would and looks perfect. Now, actually, we're going to exit the trade. Well, actually, we don't need to because it's, well, it'll expire worthless. So we're good on that. But if you wanted to exit, say, on that day or any time, you would have been okay because you would make a max profit, less just a few bucks.
So how do you exit today versus letting it expire tomorrow?
So if you let it expire, you do nothing.
Right. I mean, like, why would you exit today versus letting it expire?
So let's see, this is back on 21st, which was a little over a week ago. On that day, when it went way down and closed at the low of 171, I like to look at the option at that point and see how much money I'm going to make if I exit right there. Sometimes both options the price will come way down, and it's worth it to just get out and if I have someplace else to use the capital.
Mm-hmm.
Essentially, I'm ringing the cash register, and if I get out right there, there's only just a little bit of time value left that I'm willing to give up to exit the trade. A lot of the time, I just like to let it expire, and I'm going to get a max profit.
Sure.
So that's usually what I do, and I don't care if it bounces up a little bit. Went up to here and then came back down. That's fine. I'm just going to let it expire worthless. But back on this day, if I had limited capital and there was another trade I wanted to enter into, yeah, I would exit right there on both options and enter my next trade.
Okay.
That's what I'm looking at.
So Disney expires tomorrow.
Mm-hmm. Let's see if there's anything else that's live right now. We covered everything. Got 5 trades going on right now, and a couple are about to expire. Let's look at some new stocks and see what's going on. See if there's anything you want to jump into. And this is where you can put some stocks in for me to look at if you want to. Okay, here's Cree. Cree's in a downtrend, obviously. A lot of things show that. Number one, it's below the 200-day moving average, the green line. Number two, it keeps bouncing off the 50-day, the purple line. It went above it and came back down, bounced off it there, went above it slightly and came back down, bounced off it there, didn't even reach it right there. So where's a good entry point on it? I want to enter a bearish credit spread right there when it's up at support. Why there? Because your risk versus reward is at the best level. You're going to make more money here at $88 a share by maybe selling an 89 or 90 call compared to if you tried to sell it right now where it's only at $80 a share, $80.47 a share. Okay, right now it's not worth it really to sell a call that much higher because you're not going to make very much money on it, like maybe 20 bucks or something. So I like to see where it's up at resistance when it's in a downtrend and then sell a call a little bit higher. Couple bucks, $3 a share higher, something like that. What I do is I go in and look at the call options a few weeks out, kind of look at how much money I could get for taking on the risk. If you're not making enough money for the amount of risk you're taking, it's not worth doing the trade.
And what does that formula look like, Greg? Or is that a personal?
Well, for one thing, in general, your profits I want it to be around $100 or a little less is typically what it is. And then I don't want the risk to be more than about maybe 3 times as much, 3.5 times as much. The better you can do in terms of reward versus the risk you're taking in terms of dollars, the better. Now we'll go over all that in the advanced course, but basically I wouldn't want to do a trade like that if I'm only going to make 30, 40 bucks. Risk 400 to make 40 bucks, it's not worth it. But if I can make 100 and I'm risking maybe 300 in a very unlikely scenario to happen, then that's a good trade.
I was going to say, just for anybody that's trying to figure out with the high probability of the win.
Yeah, exactly. You think of options, you think, why in the world would I want to make $100 if I'm risking $300 or $400? That makes no sense to me. Well, yes, it does. If you're right 70, 80, 90% of the time, it's a winning proposition.
And there's a lot of ways to be right on selling.
Yeah, exactly. Now, what I'm going to do,
credit spreads.
What I'm going to be teaching like next week is how to make more money by doing options trades on ETFs or on the whole market itself, like the diamonds, the spiders, and the Qs.
Interesting.
You can do trades that are pretty far out of the money and you take on more risk, but it's really low odds of it happening. But you got to be careful. You got to have money to back you up in case you're wrong. I've heard of one trader who takes on a lot of risk. He makes like, what was it? Something like $2,000 a week, $2,500 per week on these great big index spreads. So far, he hasn't been wrong. But if he's wrong and does a max loss, he's going to lose 50 grand.
When he's wrong.
Yeah, exactly. Sooner or later, that's going to bite him.
Right.
Now, if you made $200,000 in the meantime, if you take a $50,000 hit, that's okay. But if you just start doing these trades, you've only got 60,000 in your account, right? You do these trades, you do it a few times, you make 5 grand, and then you take a $50,000 hit. That's not so good. That's way too much risk.
Sure.
Right.
So do we want to open this up to Q&A? We got 10 minutes on the clock.
Yeah, go ahead. If you have any stocks or ETFs you want me to look at, go ahead and let's take a look.
MRVL, credit spread on MRVL.
Okay, let's.
Is it Marvel?
Marvel Technology.
It is Marvel. Woo.
Interesting. So I would like to look at the background in the news a little bit on Marvel first, but definitely it's in a strong uptrend. It has only pulled back just a little bit from the highs. So if you just look at from this point on, the stock has been going sideways with resistance up around 63.50 and support down here around 60. The 50-day moving average is going up. Looks like it's holding it really well. I would probably be inclined to be bullish on this, to sell a put down here around maybe, let's see, maybe 60, maybe 59, maybe 58, depending on the prices. Somewhere down here, I'd be willing to sell a put for income and then buy a lower put, $2, $3, $4 lower, $5 lower, something like that, for protection. Depending on how you do these numbers, will show you how much money you're going to make, but also how much risk you're going to take when you do the trade. Okay. So that's what I would probably do if I was going to write a credit spread on this stock right now. And then I'd do it out a few weeks, 3 to 5 weeks, maybe, something like that.
I'm going to put another one up on the screen so you can read it.
Okay.
From my favorite name, Zero Cool.
Say again?
No, yeah, Zero Cool. I have been. Can you read that?
Hold on, I'm not looking at your chart.
Oh yeah.
Before we go further into this, I want to show you something else. Before you write any options trade, you need to know when the stock is going to announce earnings, when the company is going to announce its earnings. Why? Because earnings announcements can really drive the price of the stock up or down. And you're taking on a lot extra risk if you're selling or executing a credit spread during an earnings release. So Yahoo Finance has a great place to find when your stock is going to announce earnings. And it's right there at the top, finance.yahoo.com/calendar. You have to click on earnings. And then you click over here and you can type in any symbol and it'll tell you when earnings are going to be released. So if I want to look at Netflix, I can look on here and I can see that they already announced their most recent earnings on July 20th. And their next earnings release is going to be on October 19th.
Okay.
So you probably don't want to hold a credit spread over earnings or you could get whacked.
Sure.
Big loss. Don't want to do that.
Okay, I'm just going to read this question. I've been playing far out expirations, a couple dollars out of the money, which has allowed me to be extremely patient for a move. What's my risk here? Was that attached to a particular chart that we were looking at and I'm just delayed here? Probably was. Or are you just asking in general about the strategy? There's a slight lag between the questions and what we see.
Okay. Well, you just have to remember that the shorter your time frame and the further away it is, the less likely you're going to be successful in the trade. So if you're buying those options, the less likely you are to be successful. You're really expecting the stock to move a big move right now. So you better be right if you do that. Otherwise, you have a high odds of losing all of your money on the trade. A lot of times I'm right, but it takes a lot longer than I thought for the trade to go through. Or it goes the wrong direction and then it goes the right direction. So you got to give yourself some room for short-term error. On the other hand, that's why we're writing credit spreads. We're on the other side of that trade with high odds of success.
Another one. What do you think about GE call credit spread right now with the price up against resistance and dropping a 109, 111 with a 48-cent credit and 153 risk per contract, expiration 1015. Thank you, Zero Cool.
I like it. Look at that. You see, I love these great big stocks that are stodgy. They don't make big moves. Very predictable, which I like. We got major resistance right there about 106.50. It's up at that price. It's headed back down. So now is a very good time to write a call about 187, 188, something like that. Something a little higher. You can even do it at the money. But the problem is if it goes up much higher, you could always be exercised. I prefer it to never have the chance to be exercised if possible. So I like to put it away a little bit, but you could take that risk. You'll probably be successful in it. Let's say you wrote a 106 call, make a little more income, and you probably would be, excuse me, the stock is currently at 105. I'm looking at something else. So you could write a 105 call and make a little more money, and you'd probably be just fine with it.
We were looking at Marvel a second ago, and it has an ex-dividend date of October 7th. Does that matter to you?
Hold on. Marvel?
EX dividend date.
Oh. Usually that's not going to matter that much. Not too concerned about that. It's good to know if they've announced it. Definitely you want to check for that, but that's not my biggest concern. My biggest concern is the earnings announcement.
Okay. 2 minutes. Steve, you got anything?
You know, I was just looking at the Marvel chart, and I'll kind of make the case for be prepared for it to go the other way, because, you know, it's funny when you have, you know, the kind of chart analysis, it can go both ways, but I'll kind of make the bearish case if it breaks yesterday's low, because I'm seeing momentum is slow to the upside. I'm seeing a bunch of red bars down below on the chart right there. Well, let's go back to the daily chart.
Whoops, hold on.
Right. So right now, looking at this chart, I agree that with Greg, there is support around the $60 level. But with all the distribution that's came in, if that support breaks, I mean, I would sell the calls, right? And then buy a call higher, you know, sell a 64, 65 call and buy a call higher for protection. So right now I agree with Greg's analysis, but it is close to going the other way, right? Because it's kind of struggling at that 50-day moving average line. So just kind of keep an eye on that. If it pops, great. Greg is right. If it starts to go a little bit lower than 60, I think it could go the other way.
You know, actually, there is one thing I'd like to look at when I look at this chart. There are two things that are a little bit concerning. One is a gap down day right here, and another one right there. I want to know if there's any news behind that. It doesn't look like big news because, I mean, you got kind of a higher than normal volume with selling pressure there. I think that was Let's see. I don't know what it is. I'd like to research that.
The one before that, the biggest one is earnings. So if you go back to the end of August, that gap down was earnings. And then you had 2 more and just a bunch of red bars. So for now, it is holding. But if it breaks 60, it could crack wide open.
Yeah, absolutely. I agree with that. Because that's about where support is. If it starts to head below that, that's a sign of a new trend starting, potentially. So
kind of back on that, like be prepared, to just flip very quickly your opinion if something obviously changes, because the market or a stock can change immediately.
Okay. Some opposing.
Intraday, it is showing a little bit of selling pressure right now, so keep an eye on that. Well, it looks like we're out of time.
Okay, so let's see, we've got Monday next week. We'll do the Monday morning movers. Greg, I'm gonna send you a link. You should join us on there. We moved it to Monday because we were doing this one midweek and we had been doing something on Friday. So, and then I believe next Thursday, at 12 Central. I don't know if we've scheduled that time yet, but usually at 12 Central, we'll do Greg's advanced options presentation. Anyone that can join us on that, do so. And of course, if not, register and get a replay. Will not, but you can make it live. You can ask some questions and have some fun. Let's see. What else you guys got before we call it a day?
Go Razorbacks.
Go Razorbacks. Yeah, why not? Kudos on KRE recommendation. What happened with KRE?
Well, just the banking industry is up. Because interest rates are breaking out, so the banks are going to move with it.
Good deal. Thanks, Kevin. All right. Well, if we've got nothing else, I will call it a day. Thanks everybody for joining us. Steve, Greg, as always, thanks, and we'll see you guys on Monday.
All right. Thanks a lot.
See you, everybody.
See ya.